morning, everyone, and welcome to Kingsway's Investor Day. Thank you all for joining us here on a beautiful morning in New York at this august institution, the New York Stock Exchange. My name is J.T. Fitzgerald. I'm the President and CEO of Kingsway. I'm excited to have the opportunity to share our story with you all today, our strategy, and our vision for long-term growth. Before we dive in, let me remind everyone that some of the statements we'll make today are forward-looking and contain non-GAAP measures. They reflect our expectations based on current information and involve risks and uncertainties that could cause actual results to differ materially from those expected and projected. Please refer to our filings with the SEC for a full overview of the company's risk factors. I encourage everyone to review the detailed safe harbor disclaimer on this slide at your leisure. We've got a pretty packed agenda today. I'll start with an introduction to Kingsway, who we are, and what we think makes us unique, and I'll explain our growth flywheel, how we drive value both organically and through acquisitions. After that, our Chief Financial Officer, Kent Hansen, will walk through a business update with recent developments, latest financial results, and progress towards scaling our lean holding company structure. Next, I'll give an overview of the Kingsway Business System, what we call KBS, our framework for continuous improvement and operational excellence. Rob Casper, who leads our skilled trades platform, will then present a case study on our skilled trades vertical, which will show you how our model works in a recent real-world example. After Rob's segment, we'll open it up for Q&A to address your questions. For those of you participating via the webcast, feel free to email your questions to James, James, at haydenir, haydenir.com. Finally, we're honored to have Tom Joyce, former CEO of Danaher Corporation, join us for a fireside chat. I'll sit down with Tom to glean insights from his experience at Danaher and his participation on our KSX advisory board. Just a couple of housekeeping items. During the Q&A, we have some microphones we'll pass around to the group here. There will be boxed lunches, so I think after the Q&A and before the fireside chat, people can grab a bite to eat, and we'll keep rolling. So let's get started. To our knowledge, we're the only publicly traded U.S. firm leveraging the search fund model to acquire and build great businesses. We own and operate a collection of quality services companies that are growing, generate recurring revenue, have strong margins, and are asset light. Our goal is to compound long-term shareholder value on a per-share basis through a decentralized management model and a very talented team of operators. We also benefit from tax assets that enhance our returns. In short, Kingsway is uniquely positioned to capitalize on the search fund model at scale within a tax-efficient public company framework. So why are we so focused on the search fund model? Simply put, it's an attractive asset class for generating strong returns. The search fund approach, often called entrepreneurship through acquisition, or ETA, has a compelling track record over several decades. It involves backing talented entrepreneurs to buy and grow small businesses. We see search funds as a powerful engine for value creation, and that's the foundation of our strategy. Historical data backs up the attractiveness of the model. Research from the Stanford GSB shows that search funds have delivered annual returns in the mid-30% range over decades. This result, tracked across hundreds of search funds since 1984, underscores the model's performance. The idea is that a small, acquired business led by a driven entrepreneur can grow meaningfully and deliver outsized returns. I won't go deep into the academic study here, but the headline number on the slide, 35% IRR, speaks for itself. It's a strong endorsement that our entrepreneurship through acquisition approach can create significant value for shareholders. The search fund model isn't just about returns. It fills a real need in the market. On the left side of the slide, you see the perspective of a typical seller. Many aging small business owners want to retire but have no succession plan, no family member ready to take over, and often no attractive buyer for their business. They need an exit, a monetization event, yet these businesses are often too small for traditional private equity, and selling to a strategic buyer can be a poor fit with owners who are concerned about how that might impact their employees and their legacy. On the right side, you see the entrepreneur's perspective, a motivated post-MBA entrepreneur who's eager to run and grow a company. The search fund model connects these two. It provides the seller a graceful exit and legacy preservation and gives the entrepreneur an opportunity to lead and grow a proven business and participate meaningfully in the equity value they create. In short, search funds create a win-win. The retiring owner gets liquidity and peace of mind about his legacy, while the young operator gets a business to lead and build. Now, why do search fund acquisitions tend to outperform? A big reason is the infusion of smart, energetic leadership into businesses that often have untapped potential. A small company run as a lifestyle business late in a founder's career might be doing well enough, but it often hasn't optimized growth. When a highly motivated, incentivized operator takes over, they can uncover numerous ways to improve performance. A founder-led sales effort can be transformed into a professional sales team. Pen and paper processes get upgraded to modern technology systems. A business operating in its local market can expand regionally or nationally. And instead of just taking cash out of the business, the new owner reinvests for growth. In essence, the business shifts from a static, dividend-maximizing approach to a dynamic, growth-oriented approach under new leadership. At Kingsway, this is exactly our model. We acquire solid, small companies and put smart, energetic operators in charge. We typically target businesses with about 1 to 3 million of EBITDA, acquire them for roughly 4.5 to 6.5 times, finance with roughly 2.5 turns of debt and the rest equity, and then give the new operator the mandate, the incentives, and the support to grow the company. We assist heavily during the acquisition phase and then afterward, during the operating phase, by implementing the Kingsway Business System, our framework for operational excellence, to help these businesses professionalize and scale. A motivated operator, plus a good small business, plus aligned incentives, plus ongoing support equals significant upside. That's why the search model, when done right, can produce such great results. Let's talk about some broader context and the opportunity. We're in the middle of what we call the silver tsunami of retiring business owners. Over the next 2 decades, record numbers of baby boomer entrepreneurs will be looking to exit their business. Nearly $4.8 trillion of wealth is expected to change hands as these owners retire, the largest intergenerational wealth transfer in U.S. history. Over 2 million small businesses are projected to transition leadership in the next 10 years. This wave of retirements is going to create a huge supply of businesses for sale. However, many of these companies are below the radar of traditional buyers. Lower middle market private equity firms often shy away from deals where the key operator, the owner, wants to step away. That leaves a gap that search fund entrepreneurs can fill. With only 100 or so search funds active at any given time, there's an overwhelming supply of potential acquisitions relative to the number of buyers. In other words, demand is limited while supply is surging, which creates very favorable dynamics for buyers. It's an excellent environment to find quality companies at reasonable valuations, and Kingsway is well positioned to ride this wave by providing retiring business owners with an attractive succession solution. One of the challenges for investors is that the search fund asset class is not easy to access directly. If you wanted to invest in search deals on your own, you'd typically have to write small checks, $100,000, $200,000, $300,000 at a time, into individual search funds and their follow-on acquisitions, sourced through a pretty tight-knit network. It's a very hands-on, fragmented, and hard-to-access process that doesn't scale well for most investors. Another route is to invest as an LP in a private fund of search funds or a search fund accelerator. Those models can give you exposure to multiple searchers and acquisitions, but it usually means locking up your money for years and probably paying a second layer of fees. In short, traditional search fund investing can be illiquid, time-intensive, and potentially costly in additional fees. Kingsway changes that. As a publicly traded company, we provide an instant, liquid vehicle for investing in a broad portfolio of search fund acquisitions. When you buy KFS stock, you're effectively investing in the search fund model, but without having to source and vet individual deals or wait for a fund life cycle. And as a public company, we offer transparency and reporting that many private search fund investments may lack. The bottom line, Kingsway offers a unique, investor-friendly way to participate in the attractive search fund space, with liquidity, diversification, and transparency built in. So what makes Kingsway particularly well-suited to succeed? We believe we have several key advantages that differentiate us and drive our performance. First, we have a strong track record already. We've proven this model can work with successful acquisitions and exits under our belt. Second, we provide robust infrastructure and support to the companies we buy and the operators who run them, thanks to the systems and expertise we've developed, like our Kingsway business system. We also maintain disciplined investment criteria. We're very selective about the businesses we acquire, sticking to our sweet spot in terms of size, quality, and valuation. We attract top quality searcher talent. Entrepreneurs know Kingsway is a great platform, so we get to partner with some of the very best up-and-coming operator CEOs. Another advantage is our truly world-class advisory board. We have seasoned experts guiding our strategy and mentoring our young operators. Being a public company gives us a strong reputation and credibility with sellers. Owners take comfort knowing their company will be owned by a stable, transparent firm. We have permanent equity capital, meaning we aren't forced to sell assets on a fund timetable. We can hold and compound value as long as it continues to make sense. We also enjoy excellent access to debt financing, allowing us to structure deals efficiently with a prudent amount of leverage. And finally, as I mentioned, we have a tax advantage structure, significant tax assets that boost our net returns. All of these factors together make for a powerful combination. Kingsway is a platform built with the right ingredients, track record, discipline, talent, capital, and structure to thrive in this space. Top quality talent isn't just a slogan for us at Kingsway. It's a deliberate strategy. We believe great businesses are built by great leaders, so we have engineered a rigorous approach to talent sourcing, selection, and development. We handpick these individuals through a highly selective process, looking for exceptional drive, intellect, and leadership potential. Only a handful are brought on at any given time, ensuring we focus on quality over quantity. This rigorous vetting means that every OIR and CEO on our bench is someone we have confidence in to operate at a high level. We are systematically building a talent machine to drive our future performance and growth. Some pretty impressive people. Let's talk a second for how we decide which businesses to acquire. We adhere to a disciplined investment criteria that guides every potential deal. In practice, this means we only pursue companies that fit a clear checklist of qualities we know from experience, provide a margin of safety and drive long-term shareholder value. We are very selective, as I mentioned, sticking to our sweet spot in terms of industry, business size, quality, and valuation. Let me outline the key characteristics we look for. We target opportunities in industries that are growing faster than GDP and where that growth is supported by a long-term secular trend. Where the industry is fragmented, such that there are both lots of potential acquisition opportunities or shots on goal, and subsectors or niches are present, or even small companies can have a unique competitive advantage. And those industries possess companies with strong business models, like recurring revenue, healthy margins, and a history of consistent profitability and low capital intensity. We believe that these attributes deliver a margin of safety and set us up for solid returns on our acquisitions. Another strength of Kingsway is our truly world-class advisory board, an exceptional team of actively engaged advisors who lend their expertise and insights to our mission. We deliberately assembled advisors who have deep experience in search fund acquisitions, capital allocation, and company operations, and have all operated at the highest levels. Tom Joyce, who's here with us today, is the former CEO of Danaher Corporation. During his tenure at Danaher, he helped triple the company's stock price, and he was instrumental in developing and deploying the famed Danaher Business System, DBS, which is a gold standard for operational excellence and a set of tools we have modeled with the Kingsway Business System. We'll learn later today about how Tom brings his experience and playbook of disciplined growth and operational rigor to our advisory board. Will Thorndike is widely known as the author of The Outsiders, but he's also had an incredibly successful career in private equity and investing. Will is the original and perhaps most prolific investor in search funds and has been deeply involved in the search fund community for decades. He has a deep well of experience and pattern recognition to provide great insights to our OIRs and CEOs. And Tyler Gordy is a great example of our model in action. He's a West Point grad and Harvard MBA who became the CEO of PWSC, a business Kingsway acquired in late 2017. Under his leadership, PWSC's value grew tremendously. We sold that business in 2022 and achieved a 10x net return on our investment. His experience and insights about leadership in a small company are incredibly valuable to our entrepreneurs. Our operators and residents and CEOs have structured access to active and engaged advisors who serve as mentors to help them acquire and grow their businesses. As I mentioned, one of our advantages is a highly tax-advantaged structure. Kingsway has accumulated about $622 million of net operating loss carryforwards over the years. These are essentially tax credits from past losses that we can use to offset future taxable income. The origin of these NOLs goes back to a legacy insurance business that suffered losses around the 2008 financial crisis. While that was a painful period historically, today it means we have a large stockpile of tax assets. Why is this important? Because it means that as we grow our earnings, a significant portion can be sheltered from federal taxes, which enhances our cash flow and the rate at which we can compound value. Now that I've covered search funds and our value proposition, let's talk about how we put it all into motion for growth. This graphic illustrates our strategy succinctly. Think of it as a self-funding growth flywheel. The process has 3 steps numbered on the diagram. First, partner with amazing talent to acquire great businesses. We seek out high-quality, profitable small companies that fit our criteria and acquire them at reasonable valuations. Second, invest to grow. Once acquired, we actively invest in these businesses. That typically means upgrading the team, upgrading technology, and improving internal processes. There's often a J-curve transition period where we're investing heavily to position the company for future growth, after which the company emerges as a more sophisticated business with a better return profile. And third, reap increased cash flow and reinvest. As these improvements take hold, the businesses grow their earnings and cash flow. Because we buy them at good prices and make them better, the return on our investment is strong. Those increased cash flows, after delevering, can be returned to Kingsway to redeploy to fund the next acquisition. Over time, this creates a compounding effect. More acquisitions lead to more cash flow, which enables even more acquisitions. This flywheel will drive our long-term growth. Does this model work in practice? Absolutely, and we have a promising track record to prove it. Remember, Kingsway began slowly pivoting to the search fund model only in late 2017 with the acquisition of PWSC. As I mentioned, we had a great outcome there over our 4.5 years of ownership, turning an initial $5 million investment into more than $50 million in cash for Kingsway. We then began to ramp up the accelerator efforts in earnest in 2020 and 21. In the relatively short time since, we've completed several acquisitions and seen excellent performance from many of our companies. I think it's also worth highlighting that I've personally been involved as an investor in traditional search funds and as a former searcher for over 20 years, both personally and through Argo, investing in many dozens of searchers and their acquired companies. My experience has largely mirrored the returns we highlighted earlier, and I have developed some pattern recognition around the attributes that I think make both a successful searcher and an attractive business. We're still in the early stages of our strategy, but the evidence so far validates our approach. We view our dual engines of growth as both by acquiring new companies and by expanding the earnings of our existing ones. We're currently targeting 2 to 3 acquisitions per year and set an underwriting hurdle of 30% IRR for our acquisitions. I would also note that because the pace of acquisitions can be quicker, particularly at our skilled trades platform, and based on what we're seeing in our deal pipeline, we're reviewing our annual acquisitions expectation and may revise it higher. If you sum up our operating company's performance, our current run rate adjusted EBITDA is around 18 to 19 million over the last 12 months, and we intend to keep that trajectory going through a combination of organic growth and acquisitions. I think it's worth noting what kinds of businesses we own and how the market values them. Kingsway's portfolio is diversified across several attractive sectors. We have companies in B2B services, healthcare services, vertical market software, and as I mentioned, we just launched the skilled trades platform, which you'll hear more about today. These are sectors where successful companies often command high valuation multiples. In fact, if you look at comparable public companies or recent transactions in these arenas, EBITDA multiples are frequently well into the double digits. Our diversified approach also means we're not overly exposed to one industry cycle. We have a spread of businesses in high demand sectors. We have a nice mix of industries in our portfolio, and public peers in all these categories trade at full valuations. Finally, let's summarize our acquisition performance and what it means for the future. Kingsway has been very disciplined in the prices we pay for acquisitions, typically targeting mid-single-digit EBITDA multiples. We like to say that we get our margin of safety from business quality, not price paid. But due to the structural inefficiency in the area of the market we're targeting, we're able to acquire nice businesses on very reasonable terms. I'd like to highlight a quick case study on one of our businesses, SPI, which we acquired in Q3 2023. We partnered with Drew Richard in the acquisition. Drew's a West Point grad and was an Apache helicopter pilot in the Army before attending HBS. After an early career in a large corporation, Drew was drawn to entrepreneurship and joined Kingsway as an OIR. Drew focused his search on vertical market software companies and successfully closed on the acquisition and transitioned into the leadership role at SPI. This was a classic founder setup, and as a result, he was able to develop a great relationship with the seller and acquire that business on very attractive terms. He paid roughly 1 times revenue for a wonderful software company. Since taking over, Drew has rebuilt the leadership team and invested significantly in professionalizing the operations. In 18 short months, he has transitioned a sleepy lifestyle business with great unit economics into a growing Rule of 40 software company. Just last month, Drew completed a tuck-in acquisition of Viewpoint, which will accelerate the company's growth by bolstering both their product portfolio and geographic market. Stories like this give us confidence as we pursue new opportunities. We plan to continue this cycle, partner with exceedingly talented entrepreneurs, find great businesses at good prices, unlock their potential, and repeat. We have a robust pipeline of potential acquisition targets, thanks to the silver tsunami of sellers out there and our hungry and hardworking group of OIRs. As I wrap up this section, I want to highlight what truly sets Kingsway apart. We believe we're the only publicly traded U.S. company leveraging the search fund model to acquire and build great businesses, and that unique positioning gives us a host of advantages. We have a strong track record of success and a growing portfolio of high-quality services companies. This is a testament to disciplined investment criteria. We stick to what we know works. We attract top-notch entrepreneurial talent, and we back them with solid infrastructure and support. We've also assembled a world-class advisory board, so our CEOs have seasoned mentors to turn to. And being a public company adds credibility. Our reputation in the market helps open doors to opportunities that others might not see. Another big advantage is our capital structure. Because we're public, we have permanent capital that lets us invest for the long haul. And we have access to attractive debt financing to enhance our equity returns. On top of that, we carry significant tax assets from past NOLs, a real tax advantage structure, which means more of our future earnings can drop to the bottom line. In short, we have the people, the playbook, and the structure to keep finding and growing great businesses over decades. With that, I'll turn it over to Kent Hansen, our CFO, who will walk you through how this strategy is translating into our current business performance. Kent, over to you.
Thank you, JT. It's great to see so many people here this morning, and I appreciate the opportunity to briefly discuss the state of our business. As you can see, we've been pretty busy since the last Investor Day a year ago. At the end of September, we purchased Image Solutions, which is headquartered near Asheville, North Carolina. The day after the purchase closed, the area was devastated by Hurricane Helene. Thankfully, Image Solutions team members and families made it through, and the office was more or less intact. In fact, it served as a place where people could get running water. Davide and team got the office back up and working in the matter of days and focused on helping their clients. In the end, Davide tells me that they lost only 5% of recurring revenue as a result of the hurricane, which I think is a remarkable testament to Davide's leadership and the entire Image Solutions team. In March, just a couple months ago, we closed on the acquisition of Bud's Plumbing in Evansville, Indiana. Rob Casper, who led the search to find and acquire Bud's, will be discussing this more later in the presentation. And SPI, which JT just mentioned, also closed on a small acquisition last month, At Work International, whose product is Viewpoint. At Work is based in Mount Waverly, Australia, and my team is already fighting over who gets to visit there first. This acquisition gives SPI a nice cloud-based solution on which to build and expand, as well as opens up a broader global customer base for them. We believe all three of these acquisitions fit nicely into the KSX portfolio. Last but not least, we sold the remaining piece of our discontinued real estate segment, the VA clinic, in August of 24. With that sale, we are now fully divested of our non-core businesses. Now turning to KSX performance, revenue was up 23% in 2025 versus 2024 first quarter. This is mainly due to the acquisition of Image Solutions, but we also saw growth at SNS, DDI, and C-Suite. Adjusted EBITDA was also up 23%, mostly due to Image Solutions and C-Suite. We're still likely seeing the J-curve effect at some of these businesses. However, each one of them continue to set the stage for future growth, whether it is DDI onboarding new customers at a nice clip without any outbound selling effort, Charles at SNS focusing on recruiting and staffing efforts, or Timmy at Ravix and C-Suite finding new ways to grow organically and inorganically. We remain very excited about the future to come with KSX. Turning now to extended warranty. US GAAP revenue was flat Q1 25 versus 24, but cash sales were up 4% year over year and 9% since Q4 of last year. As a reminder, while we get paid up front when we sell a policy, under US GAAP we recognize the revenue over the life of the policy. So the amount of contracts sold in prior years does impact our current year revenue. Adjusted EBITDA decreased from $1.4 million last year to $800,000 this year. Despite the dip in adjusted EBITDA, we are encouraged by the momentum building in the extended warranty segment. The segment has returned to growth in cash sales, and trailing 12-month modified cash EBITDA was up nearly 12% year over year. Now, modified cash EBITDA is a commonly used measure to value in the performance of warranty businesses, as it more closely tracks the cash flows of the business. We use it internally, and our bank uses it for covenant calculations. The recent healthy growth in this metric gives us confidence that GAAP earnings should rebound over time as deferred revenue from those sales is recognized in future periods. I would also like to point out that at quarter end, we appointed Robbie Humble as the new president and CEO of PWI and Penn, our two auto dealer warranty businesses. Robbie brings deep industry experience and a strong leadership track record. Notably, his background and incentives are aligned more closely with that of our KSX approach. In the handful of weeks he's been at the helm, Robbie has already attracted new leadership and talent to the business. We are confident that under his direction, PWI and Penn will be reinvigorated and to drive growth and improve results. In short, the extended warranty businesses remain profitable, cash generative, and are positioned well for future success. For more information on Q1 performance of both extended warranty and KSX, I encourage you to listen to our Q1 earnings call replay. Before I turn the mic back over to JT, I'd like to share with you some things we're doing behind the scenes to ensure the continued success of Kingsway. As a publicly traded company, we need to adhere to very high standards when it comes to accounting, reporting, and internal controls. In fact, due to our continued growth, in 2024, our external auditors were required to opine on our internal controls, not just our financials, for the first time. I can assure you this is not an easy lift, but I'm proud to say that due to the hard work of all the Kingsway-wide accounting and finance professionals, we were issued a clean opinion. I believe this is due in part to something that we started undertaking a little bit over a year ago. As you can imagine, there's a wide variety of accounting acumen at the companies we acquire, and often a lot of turnover. So in an effort to ensure that we have the appropriate level of quality in our accounting and internal controls across all Kingsway companies, we began centralizing these functions into the holdco, starting with DDI. we were able to successfully absorb these functions with very minimal additional investment. In fact, by centralizing these functions, we were able to save the collective Kingsway companies hundreds of thousands of dollars. You can see that we're in process of onboarding the more recent acquisitions, and we expect to lean into this model going forward. However, we have no plans to centralize these functions at Ravix, C-Suite, or the extended warranty companies, as those businesses have local teams that are performing at a high level. We continue to believe in the power of decentralization. In this case, we view the CEOs as our customers, who are still responsible for their results, but they don't have to worry about the debits and credits and whether or not they're correct. With that, I'll turn the presentation back over to JT, and I thank you for your time and attention.
Okay, a little bit about Kingsway Business System. No points for originality with the name. So at Kingsway, we understand that buying a good business is only the start. What really matters is execution after the deal closes. This slide outlines our approach to what we call bending the curve, changing the conditions to improve the probability of success. On the left, you see typical pre-deal risks. We touched on our underwriting criteria a little earlier to filter for these factors. But it's often the post-deal risks that can derail outcomes. Two stand out based on our experience. The first, a failure to hire or retain great people. And second, a failure to execute on the plan. That's where KBS comes in. KBS is our framework for de-risking execution. We provide our CEOs with tools, coaching, and structured support to help them navigate common challenges and improve the odds of success after we acquire a company. It's designed to support first-time CEOs, professionalize small companies, and ensure a repeatable path to value creation. The Kingsway Business System is our answer to the question, how do you take a small founder-run business and help a young CEO turn it into a high-performing, scalable company? We've built KBS by drawing from proven systems like the Danaher Business System, but also the Entrepreneur's Operating System and several other, and tailored it to fit the needs of our portfolio companies. KBS is structured around 4 pillars: talent, building a high-performance team; plan, setting a direction for the company and aligning the organization to execute against it; enterprise excellence, implementing proven processes to create consistency and scalability; and finally, growth, identifying and executing the biggest levers for value creation. KBS isn't just a theoretical model, it's a practical, hands-on system that gives our young CEOs the tools they need to succeed as leaders. We start with talent because in our experience, nothing is more important than the collection of people, particularly those in key roles in a small company. Our CEOs typically inherit a team when they acquire a company, so we give them tools to first evaluate and assess the inherited group, who fits, who has potential, and where there are gaps. That includes using tools for talent mapping, organizational design, and change management. Recruit. We train our CEOs to use top grading, a rigorous, structured hiring methodology focused on performance history and cultural alignment to fill the most crucial roles. Develop and retain. We help operators implement structured performance management and personalized incentive plans to develop and, importantly, retain their best people. Once our CEOs have the right talent in place, the next critical step is establishing a clear and executable plan. At Kingsway, we approach planning as a dynamic, continuous process, not just a one-time event. Our CEOs start by setting a clear vision for the company and defining the strategic objectives to achieve that vision. They then translate these objectives into detailed long-term and annual strategic plans, complete with specific improvement priorities, action plans, and assigned accountabilities. But planning alone isn't enough. It's essential to execute and review progress consistently. That's why we've implemented a structured cadence of accountability. Each month, we conduct rigorous reviews to measure our operators against clearly defined KPIs. During these sessions, we identify what's working well and address challenges immediately, creating an agile environment where adjustments can happen swiftly. On an annual basis, our leaders perform comprehensive reviews to refine their value creation plans, ensuring alignment with long-term goals and market opportunities. This iterative cycle ensures our operators remain focused on driving meaningful, measurable progress towards their long-term vision. At Kingsway, this disciplined planning and continuous improvement feedback loop is foundational to creating sustainable growth. It's not simply about setting ambitious targets. It's about consistently working towards them and adjusting quickly when necessary. The third pillar of KBS, enterprise excellence, is about establishing scalable, repeatable processes that move businesses from reliance on a few key individuals to robust, system-driven performance. Small companies typically depend heavily on a founder or a few top performers, creating significant operational risk. Our approach shifts companies towards process-driven performance. A few of the areas, although not exhaustive, where we focus are highlighted on this slide. Voice of customer. We coach our operators to systematically capture and understand customer feedback, ensuring their services remain relevant, competitive, and valuable to their clients. Continuous improvement, or Kaizen. Rather than periodic major overhauls, our CEOs implement a culture of steady, incremental improvements, fostering sustained progress and organizational resilience. Value stream mapping. We help our operators visualize their key processes end to end, identifying and eliminating bottlenecks and waste, delivering better productivity and value to their customers. Structured problem solving. We teach our teams rigorous problem-solving methodologies to address root causes, not just symptoms. This significantly reduces repeat issues, improving productivity, and eliminating firefighting. And KPI management. By establishing clear, measurable performance indicators, we give CEOs and their teams a precise view of progress, making it easier to manage operations proactively rather than reactively. And zero-based budgeting. This financial discipline ensures resources are allocated strategically and deliberately, rather than automatically rolling forward historical budgets. We believe it's a powerful tool for maintaining cost discipline and directing finite capital to the highest ROI priorities. These are just a few best practices we deploy to create scalable and repeatable processes that enhance customer value and position our companies for sustained, profitable growth. Our fourth pillar, growth, centers around empowering our CEOs to systematically identify and capitalize on their highest impact opportunities. This isn't about chasing every possible initiative, it's about strategic, disciplined value creation. Our KBS Growth Toolkit provides practical, proven modules that our operators can use immediately, including customer retention, enhancing loyalty and lifetime value through structured retention strategies, pricing optimization, often very low-hanging fruit in small businesses. We focus on identifying opportunities to align pricing more closely with customer value, enhancing margins without compromising competitive position or customer retention. Customer and market expansion. we help CEOs find ways to grow revenue by deepening existing relationships and entering attractive new market segments. Geographic expansion, leveraging successful business models and applying them to new geographic markets, systematically scaling proven concepts regionally and nationally. New product development, strategically expanding service offerings based on insights into customer needs and internal capabilities. Unit economics. We provide CEOs with frameworks to analyze profitability at the granular level, ensuring decisions are economically sound and growth initiatives deliver tangible value. And sales force design. We equip our CEOs to build high-performing sales organizations, from structuring teams effectively to developing targeted incentive plans and accountability systems. We continuously refine these frameworks based on successes and lessons across our portfolio. That means we're a learning organization, and as we learn and improve in one Kingsway company, we disseminate best practices across all our businesses. These concepts aren't often part of the tool belt for a 30-something first-time CEO, but KBS gives them a comprehensive toolbox for value creation. Ultimately, the Kingsway Business System is about turning high-potential entrepreneurs into high-performance leaders, turning thoughtful strategy into meaningful results. It's one thing to have a playbook. It's another to put it to work on the ground. We don't just hand our operator CEOs a list of ideas and wish them luck. We provide practical training, resources, and tools to help our CEOs drive real-world results in their businesses. In other words, we roll up our sleeves alongside them to turn plans into execution. For example, we provide leadership training that focuses on the day-to-day skills our CEOs need to be successful. This includes things like establishing and focusing on the right priorities, building a healthy company culture, and communicating effectively with their teams. These aren't abstract concepts. They're hands-on workshops and coaching sessions tailored to the challenges of running a small company. We also maintain a centralized knowledge hub, a proprietary internal platform specifically designed for our CEOs. Here they can instantly access operational templates, proven strategies, detailed playbooks, and real-world case studies from across our portfolio. It's like having an experienced thought partner always at their fingertips. And perhaps the most powerful resource we offer is the KSX community. This is our expanding network of Kingsway operators and advisors, a peer group of CEOs who are walking the same path. They regularly share feedback and hard-earned lessons with one another in structured and unstructured settings. We facilitate peer-to-peer coaching, and our advisory board members are actively involved, offering guidance, best practices, and incredible wisdom. Our CEOs know they're not alone. The community accelerates learning and helps limit reliving others' mistakes. Together, these practical, supportive tools convert our ambitious plans into real-world action. I keep struggling with real world for some reason. It's a system designed and curated explicitly for the realities of small businesses and inexperienced CEOs. And it's central to our ability to deliver consistent, repeatable value creation and bend the curve towards better outcomes for our businesses. Now, to bring this to life, I'd like to turn it over to Rob Casper, the CEO of Kingsway Skilled Trades. Rob will walk you through a detailed case study of our recent acquisition of Bud's Plumbing and share how these principles translate into action and results. Rob, the floor is yours.
That advances. Yeah. Okay, great. Hello, everybody. How's everybody doing? Great. Okay, good. All right, I'm going to try to get away from the podium here, and maybe I'll walk around. I need to stay at the podium? Okay. Well, that just...
They got a roaming camera. You can use the
Is that good? Yeah. Okay. I'm not used to... I'm usually in a cinder block room, so maybe I'll try to get away from it here. Okay, I first want to say thank you to JT and thank you to Adam for having me here. This is not my usual environment, so thank you so much, and let's hope I do okay. And I wanted to say thank you most of all to our plumbers. Right now, we have plumbers underneath the house in a crawl space digging trenches. They're there, they're muddy, they're with probably some dead rat, some snake is probably contending for the space with them, and they're doing the real work. So I get to be here and have some food that I don't know fully what the name is, and they're out there underneath the house doing the actual work. So I just want to say thank you to them because I wouldn't be there. I wouldn't be here without them. So here we go. Here's a brief bio and a face for radio. I always look at it and need to thank my wife for putting up with me. But here's my background. It's 10 years or so, in lower middle market private equity. So multi-site operations, some plumbing, some HVAC, which is exciting, and then once upon a time I was an engineer, and I'm learning very slowly to get away from that. So that's my background in a nutshell. Okay, great. Let me talk a little bit about Buds because it's a diamond. It's a beautiful company, and frankly, we would love to purchase 10, 15, 20 more if we could. So we found Buds after a 5-month proprietary search. We did both brokered and proprietary. Buds is a proprietary deal, and it's the market leader in Evansville. It's the best plumbing company, and I say that objectively. I'm obviously biased, but it's the best plumbing company in Evansville, Indiana. And a brief shout out to Evansville. Evansville is the heartland of America. In World War II, Evansville built many of the LSTs that our grandfathers came ashore in, and they made the MREs that I ate on a few deployments. So I'm still here. They worked. So here's the details. We transacted. We closed on March 14th. The purchase price was $5 million. That was 6 turns on EBITDA, and there's the adjusted EBITDA. And we're very excited about the opportunities. And I'll walk through kind of the growth levers and the Kingsway business system, and we'll just go through it, and then I'll take questions at the end. Okay, great. So KBS, here's the 4 KBS levers that we have: talent, plan, enterprise excellence, and growth. I'll walk through each of these and tell you what we're doing and what we have done. So the first thing we did was address some bottlenecks, and we brought in a recruiter that I had used before, and she's terrific. She's been 20 years in the skilled trades, and so we're working very closely with her, and she's helping us address bottlenecks in the organization. There's about a 9-step work order process, and we're placing the bottleneck at our plumbers and estimators, and that's where you want to place the bottleneck, by the way. So that's been helpful. And then we've, I'm there. I'm, one of these folks with the red hair, I guess. But I'm there trying to see what are the opportunities for us to, again, grow the organization. We made an internal promotion. Jesse is our new ops director. He's terrific. I always look for that opportunity to make the internal promotion and really grow the business. And all that we're doing is we're getting the business scaled organizationally to take the next, step in the journey, to continue to drive growth through the business. Plan, here we go. And I'm gonna go through this, and then we'll get a little bit deeper on the next slide. So, it's called 80-20, but we use the Pareto role, I'm just going to prioritize what are our big buckets or big opportunities, and we use the 80-20 rule to prioritize those and go after those. Benchmarking, I need to understand and I know kind of what the industry benchmarks are by role, by department. What are our unit economics? It's another word for it. And understand why, how are we doing? Are we outperforming? Are we underperforming? Why, most importantly? Our KPIs support that. So a lot of times we'll get into these businesses and there actually won't be data collection or KPI collection. And so one of the things that we do is we implement that so we can understand how are we doing versus our benchmarks. And then after that, it's training. If we are under on one of the benchmarks or staffing ratios or any of our KPIs, the real question is why. And often that comes down to it's usually, me raising my hand, I say, okay, that's my fault. We're falling short in this area. That's my fault. That's on me. And now I got to, deliver the training to that individual or to that department if we aren't performing up to standard. And ultimately, that's some of the highest ROI, opportunities in the business. Okay. Enterprise excellence, and this is really around process. I live here every day. So what have we done at Buds? Well, we had some marketing spend that frankly was not great spend, was not judicious spend. And so we reallocated some of that. And we also reinvested in a big way in a couple channels of marketing. So that was exciting. I look at service calls. I'm in Service Titan an unhealthy amount. I was in it before this meeting, just looking at what we had on our dashboard. So I'm just trying to understand, okay, what are we doing? Are we executing in the right way? And again, if we've got some sort of left tail, unprofitable service calls, the bigger question is why? And what can I do to address those over time? Supplier relationships, that's pretty straightforward. I engage with our suppliers, and I think they still like me, put up with me. And then plumbers per truck, we really try to understand what's the appropriate, we call it the laydown or the staffing ratio for the work that we're receiving. And frankly, it differs by market. So for Buds, we have an opportunity to really go more towards drain trucks and sewer and jetting trucks, and you'll see that in the coming months. So that's that slide. Growth. Okay, this is the other area of my time. So two levers. We have market expansion, and you can see, we're really adding specialized departments. A full scope plumber will have 5 departments. They're listed there. I know not everybody is, versed in plumbing, so there it is. And we had that opportunity at Buds to really flesh out specialized departments that's going to enable us to serve the community better. And that's what it's all about. So you'll see that we're reinvesting now. We're buying some jetting units. We just bought a cabling truck. And all that is going to yield just better service and ultimately better value for our customers.